Okay, welcome everyone. We'll start our lesson 3. Today lesson will go through LO3 learning outcome 3. As you know me, my name is Anjum Satar. Please, if you have any question, drop me email anjum@ukeversity.co.uk. So I'll try to get back to you as soon as possible. So today lesson will be key focus learning outcome 3, and we'll go through the group consolidated financial statements. In a minute, we'll do a bit recap first, and then we'll start our lesson. So please, anybody, any question? Those are just listening. Please, you can drop us email either to me and you at University, or you drop email to admin@ukeversity.co.uk, and we'll get back to you as soon as possible. Okay, so or LO3, which is be able to prepare the financial statement for a group of entities. So we'll go through the parent, subsidiary, associate element, and intra-company trading. We'll discuss. We'll refer back to the handouts, which we can use. Those are available on our Moodle page via leave where it's Osman handout. So please, the question number being marked with the answers. So those will go through and we'll discuss, how we can prepare our group financial statements. Okay, anyone, any question before starting, please? If you have, you can ask, and then we can start our lesson. Okay, welcome. We'll start. Okay. During our always good to be when we start any activities, good to be we can keep and reflect, our previous knowledge, how much I already know about the consolidated financial statement. Most of you already working in accounts and you know the consolidated statement. Maybe you study in other financials or in other course and you learn about the financial statement, how to prepare and present under IS1, International Accounting Standard 1, which is about, uh, financial statement need to be true and fair, and we prepared 4 types of financial statements. Statement of comprehensive income, which is also known as profit and loss or income statement. Second statement is the statement of financial position, which is mean balance sheet, show the asset, liabilities, and capital, or we call equity, and statement of cash flow, which shows operating, financing, and investing activities in the financial statement. A statement of change in equity, which is mean the equity statement. These are the very important statement, and we prepare in account, and we should have the basic knowledge about these statements. Okay, we'll start. Okay, so under IS2, which is International Accounting Standard 2, we discuss about in our lesson 1, accounting standards, so which is about inventory. Inventory should be recorded at cost or net realizable value, sale value, whichever is the lower. So we should, an inventory have 3 evaluation method, which normally we lost in first out method we're not using. It's not allowable under IS2, but is absolutely fine in the management accounting. Raw material, finished good, and work in progress. 3 types of inventories and 3 evaluation methods, especially for under IS2 we use, first in, first out. Average cost of inventory. That's, these are methods we use. Parent. What is meant by parent company? If the company owns more than 50% shares of other company, that's the company who own it is called the parent, and other will be subsidiary. So if you own 20 to 49% of the shares of other company, that will be called associate of the parent. They have an association. The single line treatment will show. If we have a less than 20% shares owned by a other company, we call this is the simple investment. You don't have a significant control on their board of management. So that's key, really we need to be look around when we prepare the financial statement or the group structure in okay, so today lesson we'll go through and prepare indicative contents, and in group structures, prepare the parent and subsidiaries financial statement. It will look. Okay, so under IS7 is called International Accounting Standard 7, which is about prepare the financial statement of cash flow. Cash flow have inflow and outflow. We look three activities, which is the key under IS7, operating in investing, and we look direct and indirect method, direct, and these are two methods. So we have three activities: investing, financing, and operating. Operating is the normal activities. Investing, if you're non-current asset, previous years, you are investing in the non-current asset, that called investing activities. And financing activities, if the money you borrow through the issue shares, or you borrow money through the non-current equities like a bank loan or mortgage. So these, known as financing activities. Okay. The layout of the cash flows always good to be your draw the statement of and the year end and the company name. Of course, that's the standard, but before profit, the tax which you prepared in the financial statement of comprehensive incomes, you can pick the figures from there. You do adjustment because the finance cost is mean the interest, you add it back. Depreciation is a non-cash expense. First place you minus from in the statement comprehensive income. Dividend received you put as an income, other income, but we minus because not come under the operating activity. That's why the gain on the loss as a disposal of property, plant, equipment, we added because that was the other income of the losses, because the first place it is a gain, you add it as the other profit, but so now we'll do minus because it become a zero effect because the gain come under the non-investing activity. Increase in inventories. If the inventory is increased, the cash will be decreased. If decrease inventory, the cash will be positive. Increase in inventories mean the inventory is stuck, in and your cash flow, or decrease inventory is a positive. So we do adjustment. Increase in trade receivable. If the receivable increase, the cash decrease. If they increase trade payable, the which are decreased trade payable, which is negative effect, so we minus. So cash generated by operations, interest paid, which is mean finance cost, and the tax paid in during the year towards cash. So we can say net cash from operating, investing, and financing activities, how much we have. So, but if you want direct method to use, cash received from customer, cash received from supplier, cash generated from operation, interest. So these we can look around these activities under operating, financing, and investing. Then we can look around in investing, purchase of property, plant, equipment, disposal of property, interest received or the dividend received, these increase or decrease previous years, which we carry on or received during the year. So we can look around the net cash from investing activities, what's happening, increase or decrease. Financing activities, the share capital last year, this year went up, went down. Increase in the bank loan last year, this year. So what is the happening impact on the cash? So dividend paid, if we pay it, so that's also is the cost. Net cash used in the financing activity, how much was, plus we can look around operating, investing, financing, their positive or negative cash flows. We do the net increase or decrease. Opening balance of the year, which is given in the balance sheet, and we do the ending balance, which is given in the balance sheet, that should be equal to this figure, and we can say is between the reconcile, that's which we can look around. Okay, guys, so now we look around. These are all activities as mentioned earlier. The cash generate from operations like Tesco, their normal business to sell the consumer goods, so any cash generator payments, so that come operating, financing, investing. If you have spare cash, you're investing by property, plant, equipment, or any other third company, so that's come under investing. Financing, if you borrow money through the share. So we can look around the advantages and disadvantages. Of course, the cash flow is very useful technique. It's look the liquid position of the company. Some limitation, cash balance sheet can be manipulated. Sometimes it is possible to focus cash flow at the expense at the profit. So replacing the plant or the equipment in the long run needs to be both, survival, then we need to be looking around. So guys, now we have a question, 6.3 and 6.4. So what do you need to do, please? You have to go back to our standard handouts, which is given our Moodle page. I'll quickly show you our Moodle page. And that's, quite good to look around our Moodle page. So that will help you to, uh, give me 1 minute. I'll quickly show you. That will help you. Okay. So if you look, please, here, you've been given the handouts. It's called Kaplan. So where is the, sorry, it's the Osborne handout. We have a Kaplan with Osborne as well. If you look here, so carry on looking down, so you will find here is Osborne. So Osborne tutor, yes, which is mean answers and Osborne. So we said, so if you look within the handouts, I said 6.3. So you go chapter 6. So you look at chapter 6. Yeah, so if you look at 6.3, so we've been, yes, so this is the answers of the solution activity. So we can look around profit before tax adjustment we've done, and we found the profit net cash from. You can pick the 6B part where we done the investing, financing activities, and the net cash balance we have at the end of the year, all the work. So which we can look around these, or if you want to go back to 6.4, task 1 and task 2, that's quite good to look around, and you can pick the examples, and if any point you not get it, so please you can ask, so we can go through in during our further lessons, or if you need help, so we can discuss one-to-one. So that's all, the way we can do. And I'll take you back to our slide. And now we can look around second element, which is 3.2. A group consists of the parent and the subsidiaries and all those, which earlier we said, which we had a discussion earlier. We can look around the parent and subsidiary company. And you, good afternoon. Thanks for joining. So we can look around the parent and the subsidiary. If the parent is on 50% or more shares of the subsidiary, so that will be the parent and owned by other company, that will be known as a subsidiary. And if you own it, so parent, we discuss under L1 3.1 as well. If you own it more than 50%, so that will be the parent, other company will be known as a subsidiary. So we can look around, and then if you own it 20 to 49% shares of other company, that will be known as associate. So that's, the group structure, significant control they have, the intra-company trading we need to eliminate. So if you have investment less than 20% in other company, or you own the shares of other company less than 20%, that will be called simple investment, or you just call investment. So that's the way we can, and the subsidiary and the board of governance and the control element, that's we need to be look around accordingly. Okay, so in this, the control investor and investee, if we, an investor has all the following, the power of our the investee, exposures at the right of the variable returns, and all the board of management control, voting rights are significant. So these, we need to be keep in mind, when we do. So please, when we will prepare the consolidated statement, always we need to be look around the first group structure. What is parent and the subsidiary? If the, let's say, P owns 80% of S, so parent is 80% at the date of acquisition, and the goodwill adjustment that need to be made accordingly. Of course, this is your assignment based course. So please, we can use the scenario, we can pick from the book, and I giving you answers is a matter of little explanation. And but these are the steps, that we follow. So the 20% will be known as a non-controlling interest. So non-controlling interest, how we can calculate the share capital of S, which is subsidiary at acquisition, times by 20%. That will be the non-controlling interest element. Retain earning, which is mean the profit, retain profit. So 20% of that, which you can find from their balance sheet, the figures will be given in the question. Fair value adjustment, if the value of the asset is went up, so 20% of that can be fair value adjustment, like asset you recorded 100,000, now is 120, so 20,000 is the fair value adjustment. So the 20 times 20%, so we can look around. So net controlling interest at acquisition, add them all, that will be your 20% net controlling. Goodwill, how we can calculate, that's step 3. Consideration, how much we what is the goodwill. Net asset, so accounting equation, so we can look around total asset minus liability is equal to net asset. If somebody is willing to pay more than the net asset, the difference will be why they paying it, it's called goodwill. So like net asset 300,000, we are paying 360,000. 60,000 is our goodwill, but the goodwill can impaired if the company not perform or the reputation of the company drop. So that's that's it's called impairment. Impairment is a loss, and we have to minus from the goodwill amount and then net goodwill. So we can under FRS 3 we can combine their financial statement, intra-company trading we can eliminate. Any question from him? Please, if you have, you can ask. Okay, so calculate, then we consolidated return earning. So we always 100% of the parent return earning plus at the date of acquisition, after the date of acquisition, what is the income of the company, and we need a percentage of that company, which is 80% of that, less at acquisition group shares. So we can look around less at acquisition. So anything before, so we can minus those. We don't need to be include intra-company or intra-company trading or impairment. Those are the losses which we need to be adjusted, less impairment of the goodwill. Then it's come our total consolidated as a group, how much return we have. Non-controlling interest at the year end, calculate the share capital of S, which is being the subsidiary, return earning of S, fair value adjustment of S, and non-controlling interest at the year end. That will be, and these figures goes in the consolidated statement. We'll look, these. So what we can do, we can say assets, parent and subsidiaries, intangible is goodwill, which you calculated in our working, and the non-current asset, parent and subsidiaries, we need 100% to add it. The current asset of the parent and subsidiary is 100%. You just adding their values, and the share capital only the parent, don't include the subsidiaries, please. And the return earning, parent plus 80% of the subsidiary post acquisition, as we done the working at the top, which we mentioned, and the non-controlling interest 20% of which we calculated as the working, and add them all. That figures will be equal to your asset, but plus your liability figure, accounting equation. So what is the accounting equation? Asset we always equal to, it goes on the debit side, liabilities goes on the credit side, plus capital goes on the credit. Okay. So if we'll say assets minus liabilities, we can say is net asset, and the net asset always equal to capital. Yeah. Earlier we mentioned if the net asset or someone is paying more than the net asset, that difference will be a good. That we need to keep in mind, always, and by using these formulas we can calculate. Okay, so of course we can calculate group structure, we can calculate the non-controlling interest following these steps, and we can, when is the income statement of consolidated all the revenue, if we have an intra-company trading like company A, B, So because intra-company trading, we need to eliminate. Intra-company buying, we have to eliminate. Then gross profit, then operating profit of the parent and subsidiaries. Then the finance cost, parent and subsidiary, the profit before. Then we have attributes. Attributes we need to be like, equity holders of the parent plus subsidiary and the non-controlling interest, which is mean 20% of the of the subsidiary that we don't have a control on it. The rest 80% we have the control on it. That's really we need to look around and we need to calculate. Intercompany, of course, we can look around the revenue cost and we make certain adjustment by looking if there is the element of intercompany. Okay, so now we've been given in this handout for the sake of our assignment. We can pick some example. So I'll take you back to our Moodle page. We are using Osborne handouts for this, So we go back to, and you will find here Osborne tutor zone, which is mean our solutions of the questions available, and we're looking 8.3. So go back to our chapter 8, and the question you can pick, as example to choose, and you have a question, and this is 8.1. So we're looking 8.3, which we said. So this is the group, we have two, we have Clark and Bell, two company, and we calculate all the working bit, and we can use, 8.4 and 8 to 8.67. These are examples to be. We can look around the revenue, we can look around the group stake, and we can say the profit and the attributes, all their working are given here. So please, these are good examples to use for your assignment purposes as we discuss, in our PowerPoint slide. So you've been given all the groups. Yes. So consolidated statements are, let's see the balance sheet of Moore PLC, their working been given, and then we can look around the profit and loss of these group companies, their revenue being combined, the cost, and then of course, the working is here, and that's that we consolidating intra-company profit and loss being eliminated. That's it's really we need to look around when we prepare financial statement as example for our assignment purposes. So any question, please? Any point you want me to go over? If you have, please, you can ask, so always welcome.
Is it over 50% is how to say if over 50% the company is 100% control the company, so it is subsidiary, and in this consolidation should count 100% of the capital, right?
Yeah, basically, the consolidated with the non-controlling interest. Yes.
Okay.
We have to take it. We have to put it. 20% we have it non-control. But as a management perspective, yes, you have a control on their board of governance. You make the rules and regulations for their company.
Okay.
Yes? So you have an influence. Yes, significant influence on others.
Okay, but the point is,
and the
control is more than 50%. How about if just 50%?
Yes, doesn't matter. It's 50 or more.
Oh, okay. So once 15 is a subsidiary.
Yes.
Okay, okay. And less than 15, we will based on pro rata.
Associate.
Okay, okay.
So you can only, because then it's mean you don't have huge, but you have a control because you have more than 20% shares in that company. Yes. So you can influence, but you can't really 100% control them.
Okay. Okay. Got it. Thank you.
You're welcome. So here as we mentioned in P&S parent and subsidiaries, we have the definition IAS 27, which is mean International Accounting 27, give the guidance about parent, subsidiaries, and associate, which is good to follow. which we can look around separate standard, any intra-company trading, which we need to be eliminate, because that's, that we have a always problem, and the mechanism we have to follow. And then we've been given here the ACCA used through the various changes in the structures, and the handouts is there. And if we want to look around the question 8.6, which we just seen now in our Osborne handouts, that's, we have. So for our assignment, we can pick, the to argue. You've been given the question, you've been given the answers for this. Plus, we have the Kaplan handout, which is, if you want to download yourself, we can say from Open Tuition, which we mentioned a few times, Open Tuition, and we can look around FR. What is the FR? It's called financial reporting. We can say 7 exam of ACCA, and you can download. That can be, and I'll share with you the Kaplan booklet, yes, the workbook, all the questions there, and you can pick any exam. Of course, intra-company trading, it can be huge, it's a huge question, but you can pick as an example because you're not appearing in exam, so it's a matter of picking example to meet the criteria, which you can explain, this is parent, this is subsidiary. So that's, that's the way really we need to look around. Then we have the merit criteria, analyze the requirement related to the foreign transaction. Due to the increasing global investment, we do the foreign company, but we need to be look around the board of control, where the company head office is based, who make the decision, where the company is written, and we have to apply the principle accordingly. That's, so we have IFRS are not enforced in any countries. They are developed by international organization, has no international authority. To become enforceable, they must adopt the country's national financial reporting standard setter within the European Union, yes, and then of course adopt all the listed entities after 2005, and of course European Union extended and all, and we move more towards international accounting standard, but it's international and the local standard is quite similar now, and they carry on, because the local standard, international standard being embedded to the local standard to more consistencies, and the people can understand. So here been given the link for further please reading. We can read, and we can look around the chapter of the book being given to you if you want to for the merit criteria, and you can use as example. Then we have a D, distension criteria, evaluate the need and prepare the detailed financial statement when changing the group structure. So here we can look around the group structure, the new company, intra-company trading, those examples we can pick, which we 8.8 we mentioned fair value adjustment. Fair value means the asset value increase or decrease after that, the fair value adjustment when we do, and we'll make the acquire the company, then purchase consideration happen. That's, which we can look around. If you're doing these elements in fair value adjustment, goodwill calculation, and you're giving all the working, yes, end to gain, and that's you showing in your assignment under the distension criteria, then of course you meeting the distension criteria. That's, which we can look around. So I can take you back to, I can share with you the first, the handouts in the chat box. That's, the, I think so I shared you earlier, but I can re-share with you. So we have the booklets, yes, where we can pick, so of course we'll do the assignment discussion session separately. That also help us, and I'll quick share with you ACCA handout first. That's quite, I can share with you various others because, different IFA itself not published the books, there, but they gave the syllabus too. And we can use any resource to meet the learning outcome and to prepare our assignment. So we can look around these. I'm going to share with you now on chat box a minute. So that's booklet we can use it for. If you want to look around consolidated elements within the book, So that's quite good to, for the sake of, our own understanding about the question and answer. That's quite good to go through these. Huh? So I shared with you, I can share with you postbone, those are available on our Moodle page as well. So that also helps us to go through. Normally we use for the
Okay.
Osman handout for AAT level 4 qualification as well. So ignore it, what is the written for qualification, but it's quite good to be include examples, either picking from Osborne. I have BPP as well. I can share with you. So you can pick, doesn't matter, whichever, the handouts. Yes. So you can snip it, you can say this is for the scenario, and you can include, in your assignment examples for the sake of to meet the criteria. So I'm sharing with you this also, which is
Yeah.
chapter activities, and which I reference slides. So you have, those will be as a reference material as well. And other than that, if you want, I can share with you the BPP as well. Of course, these are different the publisher. So luckily I deliver these and I have all these publishers, the handout. So I can share with you this booklet that also helps us. So I can share course book. So there are plenty of, stuff there on the consolidated in the group. I can share with you the review. So it's a plenty of examples we have, because really it's not exam based. So we not too much, but it's good to be for the sake of our own understanding. When we when we're dealing with clients, it can be issues consolidated, associate, and subsidiaries, where we can. That's the big companies where we need to look around. Okay, so I shared with you today lesson. We discuss about the cash flow, or LO1. Sorry, our 3.1. How we can prepare the cash flow. We've been given the cash flow examples to take you back to, and which we discuss, in slides. So we had operating in investing financing activities under IS7. I discussed with you how we can extract the information from the statement, the information we can use to prepare this consolidate the cash flow statement of the company, investing, financing, and cash flow. It should be there when we reconcile the net cash balance of operating, financing, and it should be equal to the closing balance given in the financial position of the company, which is in balance sheet. So that's what we discussed, and we refer back to the question 6.3, 6.4 that's given in the Osborne handout. So I'm referring all these questions from the Osborne handouts, which is chapter activities and answer activities, which I just shared with you via. So that's, I think, so when you join from 3.2, yes, which I will discuss. That's, was all the consolidated and parent and subsidiary. We had a discussion. Okay, so that's all from my end. Please, if you have any questions, feel free to ask and we can go through.
It's okay. Yeah, no problem. Yeah.
Okay. So thanks for attending and have a lovely weekend. And I'll speak you. You can go through these questions. Yeah. If any question not logical makes sense or we can't, what we can do, we can go through the question itself all in details.
Yeah. Okay. Yeah. Thank you.
Working is a given, but the standard formulas, which those are given in the slide, we normally follow, and we put the figures and we calculate, and then we consolidate.
Yeah. Okay. Yeah. Thank you so much.
Thank you, and have a nice time. Thank you.
Okay. Thank you.
Bye-bye.
Bye.